Hi friends, good day. Today I'm taking out a new topic called as amalgamation of partnership firms. We are also having in your group 2 amalgamation of companies. We are talking about amalgamation of partnership firms. Amalgamation of partnership firms. Actually, I told you that we are having two problems in this amalgamation of firms. You don't have many models. Most probably, this model has been repeated number of times, around 7 to 8 times. It has been repeated. This particular model. So, amalgamation of firms. This is a number of times, 7 to 8 times. It has been repeated. So we are having only two problems actually. The same problem is there in our metal 5 to 6 times, various ways, various papers and values change, the company name, partnership firm name change. So amalgamation of partnership doesn't have much significance because you are also having amalgamation of companies. Having said that, you can expect even this in the examination also. Now the question is that, sir, in maximum possible loss method, like this is only for information I'm giving you. We have left out with a few problems which I haven't taken from the material in this total partnership. There are six more problems I wish to take, but it is too lengthy because we have been discussing almost 20 classes. Since 20 classes, we have been discussing about the various partnership issues. But I think you need bit of practice because you need to revise those problems twice or thrice. So what I will be doing, like before after completion of the entire syllabus, partnership six problems, which will be like like advanced stage. I mean, advanced stage is nothing but few uh, important adjustments which you need to make. So unless if you're good in these things, only like a partner has been admitted, they've continued business for 1 year, then firm went for dissolution. One partner has become insolvent, remaining partners continued their business for a while, then firm has been dissolved, or one partner has become insolvent or retired, like that, or a partner has died. We are having some adjustments like that. Those things, like it is like a combination of foundation plus dissolution. Foundation is reconstitution of partnership from admission, retirement, death. But with that adjustments, partner admitted, they've done business for a while, firm went for dissolution. Partner retired, firm immediately went for dissolution. Partner has died, firm went for dissolution. And like partner has become insolvent, firm went for dissolution, they have sold to company. Various, I think these are basic things, but how to approach to that I'm having some plan. In that plan, even the second problem which I'm not taking out. So in 2 classes time, I wish to finish off this amalgamation of partnership firms. Then you will be having some basic idea, and with this knowledge also, definitely you should be able to do it. Maybe somewhere, sometimes you may be struck up. So what I'm planning, actually every batch I do the same thing. I told you number of times also. I'll be revising, not immediately, because if you got the gap after studying the all chapters, and you'll be fresh before the examination. I mean before the examination means after completion of my syllabus, whatever I'm the topics I'm taking. So around six problems roughly, I'm telling you, maybe five or six, depending upon that. Then, or we can like there are some problems from study material. Those problems will be repeated in the examination. So we can go through study material instead of working out wherever is required. I'll be working out. So this is what my plan, that I'll be um, wish to work out after completion of the my syllabus part, right? So today's class, as I told you, I'll be telling you about amalgamation of partnership firms. Sir, what is amalgamation of firms? When two or more partnership firms join under common management, two or more partnership firms join under common management. The partners of the old firm will become the partners of the new firm. The business of the old firm will continue as a before through under a single name. Let me give a small example. Suppose AB partnership firm. Then you got CD partnership firm. Now, in future, these two partnership have firms have become ABCD. So this is new firm. Okay. So this is now AB was having management different. CD firm is having management different. Now ABCD is a new partnership firm. ABCD is a new partnership firm. So that means in case of amalgamation of firm, two or more firms, it can be EF also. But I've taken only two partnership firms. It also can be EF or GH like that. Two or more partnership firms join under common management. What is common management? ABCD. The partners of old firm will become the partners of the new firm. The business of old firm will continue under a single name as before, though under single name. So here A, B were partners, C, D were partners. Now they have become partners of new firm. This is what the meaning of amalgamation of partnership firms. Why? Because to avoid competition, to reduce their common expenses, and to reduce advertisement expenses, to expand the market. There are some economics in there is economics in amalgamation of partnership firm. So and with one single management, they can take quick decision, and the intellectual people of both the partnership firms can come together, and they can go for uh, even the advantage is that they can have, they go for expansion of the business, and you will be getting more capital also can be pumped into it, and you also can able to attract the customers. Like, I mean, there are so many advantages by having this merger of these two firms. Okay, so let me give few lines on this. In case of amalgamation of firms, two or more partnership firms join under common management, the partners of the old firm became the partners of the new firm. The business of the old firm the business of the old firm will continue as before, though under a single name. Though under a single name. In case of amalgamation of firms, two or more partnership firms join under common management. The partners of the old firm will become the partners of the new firm. The business of the old firm will continue as before, though under a single name. Now let us look at the accounting entries for this. Accounting aspects. See here, you should learn the accounting aspects here. Accounting aspects of A and B, accounting aspects of C and D. This is one. Then accounting aspects of new firm. Okay, here accounting aspect, that means we will be having common things. We will be learning like accounting aspects of A, B, C, D. Common. A, B and C, D. This is first one that you will be learning. Then accounting aspects of new firm. This is what you should remember. So we are having totally two aspects, accounting aspects. One is accounting aspects of A, B, C, D, that is each firm separately. Accounting aspects of new firm, that means A, B, C, D. That means you should write entries of A, B firm, entries of C, D. But the entries are common. Accounting aspects are common, but you should write entries for A, B and AB firm and CD firm. Then you should write accounting aspects of new firm means here A, B, C, D. So these things you should learn in today's class. Okay, sir, what is accounting aspects? Suppose AB firm is having balance sheet is a source, no? Balance sheet is a source for AB firm. Balance sheet is source for CD firm. This is AB firm. This is CD firm. Now you want to transfer the capital balances of AB to the balance sheet of the balance sheet of assets, and the balance sheet which is consisting of assets and liabilities of AB firm and CD firm along with capital, that is total business has to be transferred to ABCD. Here also total assets and liabilities information has to be transferred to ABCD. Now then when you want to transfer the balance sheet on the date of amalgamation of AB firm, balance sheet on the date of amalgamation of CD firm, the assets value generally book value, no? Assets will be book value. Of course, liability is also book value. So when you want to transfer your assets and liabilities, when you're showing it book value, you really, I'm talking about this one, first this aspect I'm talking about, accounting aspects of ABCD, that is each firm separately. So first what I do generally when I am looking at these things, my dear friends, my emphasis will be on like I want to revalue my assets. I want to go for evaluation of assets. Simple. Liability generally no need to revaluate. Reassessment, of course, that is on the date of amalgamation only they have done it. So no, there will not be any problem. As for liabilities, unless any one of the creditors has agreed to forego the liabilities. So generally assets. But having said, let us learn like this. Whatever you learned in foundation, like admission of a partner, retirement, death, we used to prepare revaluation account. No, same revaluation of assets and reassessment of liabilities. That point, first point, you should remember. It can be for AB firm and CD firm. So when you look at the accounting aspects one by one, I explain. I'll write accounting aspects of. This is first point. Accounting aspects in the books of each firm. Accounting aspects in the books of each firm. What are those accounting aspects? It means first one, prepare revaluation account. I am not going to give the entries. You all are aware how to write the entries for evaluation. You will learn that. Prepare revaluation account and transfer profit or loss on revaluation to partners capital. You know that prepare evaluation account and transfer profit or loss on revaluation to partners capital accounts. You know that how to prepare evaluation: increase in the asset credit, decrease in the liability credit, decrease in the asset debit, increase in the liability debit. The difference between evaluation account will be transferred to the result of revaluation account is transferred to partners capital. Same concept. The first point number one, you should prepare evaluation account. So assets and liabilities has been revalued. Then goodwill treatment. Goodwill treatment means sometimes each firm may say that when we are merging with other firm and we are having a single management now, every partners of the firm will feel they are having some goodwill. That goodwill we want to raise. Suppose goodwill treatment. Goodwill treatment. What they do? That is on raising goodwill. What is the entry you write? Goodwill account at R2. Goodwill account at R2 partners capital account. If the old partners, the respective firms partners have decided to raise the goodwill, you should write the entry for goodwill account at R2 partners capital account. So goodwill adjustment. This is if it is given in the problem. If it is not given in the problem, no need to worry about it. Then transfer undistributed profits and losses. Transfer undistributed profits and losses to each partner capital accounts. You know the undistributed profits mean general reserve fund, P&L account credit balance or P&L account debit balance. This is to be transferred to partners capital account. Then fourth point. And sometimes what happened, partnership firms like AB partnership firm, CD partnership firm, they don't want to carry some of the assets to new firm. Or new firm, when they have decided to merge and they have decided like these assets are not required, or some of the firms, partners of the firm don't want to transfer some of the assets to the new firm, or whatever it may be, that we won't be knowing. It has to be given in the adjustment, that has to be given in the problem as information. So suppose assets and liabilities taken over by the partners, if any such information is given, we should write the entry for assets taken over and liabilities taken over. So here I am writing assets and liabilities taken over by the partners. Okay, here entry for assets taken over. Normally in dissolution of partnership, we have written the entry like partners capital to realization, because all assets were transferred to realization. Here we are not opening realization account. There is one more school of thought where the way we do for amalgamation of companies, that procedure also can be followed for amalgamation of partnership firms. But actually, your study material this particular concept has been followed. So this is because to have a clarity of thought, just I'm telling, even after completion of amalgamation of companies, the same principles can be applied, like ascertainment of purchase consideration, entries in the books of transferor, entries in the books of transferee. These terms we'll be using there in company. After understanding the company accounts, you also can try, but generally they won't be asking you to open one or two problems like in practice manual, like in IPCC previously. One or two problems have been worked out in that particular model also. But generally, the study material has been given that we are going like opening revaluation account, treatment of goodwill, transfer of undistributed profits and losses, assets and liabilities taken over by the partners, if at all, if any information. Okay, just I'm going by that. This is only, I don't want to confuse you, because whenever you suddenly refer to any material, maybe sometimes the explanation is different. I've been telling you only that is possibility. There is a possibility of such kind of things only in partnership account, but not in other chapters. Entry for assets taken over. So entry for assets taken over is that is the reason why most of the students they feel that partnership account is difficult. Reason is that what they learn, what has been taught by the faculty may not be sometimes maybe the same when you look at your study material or scanner or whatever it may be. So because in partnership you got various ways of doing the things. So but having said, but you what if you understand the concept now, if you got the clarity, you can understand anything, right? No need to worry about it. So entry for assets taken over. Here who is the receiver? Partner. So the concerned partner, concerned concerned partners capital account at R2 asset account. Entry for assets taken over, concerned partners capital account at R2 asset account. Entry for liabilities taken over. Okay. So liability will show credit balance notes. Therefore, to close that, which should be debited. Liability account at R2. Who is going to pay this liability? The giver is partner. Concerned partners capital account. Now, when you are going for amalgamation, the AB partnership firm accounts has to be closed. CD partner, the example I have taken there, I am telling you. AB partnership firm accounts has to be closed. CD partnership firm accounts has to be closed. Now, after preparing revaluation account and transfer of undistributed profit, adjustment of goodwill, now you are left out with, after taking out assets, if at all any, by the existing partners, or taking the liabilities, remaining assets and capital balance will be there. Simple words. Assets, remaining liabilities at agreed value, and mean at a revised value, rather not agreed value, revised value. Revised value means when you are going for revaluation account, that will be revised value. Revised value of assets not taken by the partners and liabilities not taken by the partners, and capital account, and that has to be transferred to a new firm. That is what we'll be learning in the fifth stage. So that is E. A, B, C, D, E. Now that is what we'll be learning. Entry for remaining assets, comma, liabilities and capital taken over by the new firm. Taken over by the new firm. Entry for remaining assets, liabilities and capital taken over by the new firm. This is generally at revised values or book values. If you are going for revaluation account, revised value. If there is no revised value, book value. It can be revised values or book value. Of course, capital is not revised value. Capital will be after adding revaluation, profit, etc. We are talking about only revised assets and remaining assets and liabilities. Capital will not be at revised value. Of course, you can say adjusted value. No issue. Now, here, this also I am splitting in two parts. Entry for remaining assets taken over. Debit the receiver. New firm account debtor. What is going out? Asset is going out. New firm account debtor to asset account. Entry for liabilities and capital. Entry for liabilities and capital taken by the new firm. Entry for liabilities and capital taken by the new firm. Liabilities account debtor and capital account debtor, this you are transferring to which firm? New firm. So the entries which I have given is applicable for the transferor firms. The firm which are transferring, the entries will be applicable for them. Either it can be in the example I've given A, B or C, D. The entries will be common. Now instead of writing these entries like first entry, second entry, we can write alternatively. Alternatively, what is common? New firm common, no? So we can write liabilities account debtor. So the balance sheet is liabilities plus capital is equal to assets. So the same concept. Liabilities account debtor, capital account debtor to asset account also you can write. Instead of writing 1 and 2 above. Instead of writing 1 and above, 1 and 2 above, we can write like this. Instead of writing 1 and 2 above, we can write this entry. Liabilities account debtor, capital account debtor to asset account. So I think these are the entries which you should learn. Very simple. Point number 1, come on, tell me. Prepare revaluation account and transfer profit or loss on revaluation to partner's capital account. Goodwill treatment on raising goodwill account debtor to partner's capital. Transfer undistributed profits and losses to each partner, that is by preparing capital account. Assets and liabilities taken over by the partners. Entry for assets taken over concerned partners capital to capital account asset. Entry for liabilities taken over liability account debtor to concerned partners capital account. Entry for remaining assets, liabilities and capital taken over by the new firm. Revised values, that is book value. Revised value or book value. Entry for remaining assets taken over. New firm is the receiver. What is going out? Assets are going out. Entry for liabilities and capital taken over. Liabilities account debtor, capital account debtor, new firm. Or we can write combined entry. Instead of writing 1 and 2, we can write liabilities account debtor, capital account debtor to asset account. Okay. I think slowly you can easily learn this. The second point which I will be telling you today is entries in the books of accounting aspects in the books of new firm. Accounting aspects in the books of new firm. in this. Point number 1. Incorporate, because the respective dissolved firms, I mean the merged firms, assets and liabilities have become new firm assets and liabilities. No, so we need to use the term incorporation. So incorporate assets, comma liabilities, comma capital accounts of each firm separately with revised values. The entry will be here. Asset account data to liabilities account to capital account, because they are receiving, no. So debit what comes in asset, and also they are getting the liabilities. Liabilities will show credit balance, assets will show debit balance. And assets, how they got it with the help of liabilities and capital. That is the logic. This is source. This is like application. Assets account at R to liabilities to capital account. This you will be writing like in the books of ABCD in the example. ABCD is the new name of the new firm, where partners of AB, partners of CD has become partners of ABCD, new firm. Then treatment of goodwill. See, when the partners have brought their assets and liabilities, respective firm partners have raised the goodwill. Now that goodwill, if they don't want to show, that goodwill they have raised, that goodwill they don't want to show, the goodwill will be written off in the books of the new firm. They are coming, they're bringing their goodwill, by raising goodwill, that goodwill will be written off the new profit sharing ratio. That is what I'll be giving. If goodwill is raised, if goodwill is raised, it is to be written off. If goodwill is raised, it is to be written off in the new profit sharing ratio. In the new profit sharing ratio. If goodwill is raised, it is to be written off in the new profit sharing ratio. However, like they have decided that when they're bringing their assets and liabilities, don't raise goodwill, but you can raise the goodwill after you come to the new firm, and you can raise the goodwill, you can write off the goodwill. But okay, but having said, suppose you haven't done any adjustment of goodwill in the respective partnership firms. Now what you have decided, now you have decided that without raising goodwill, we want to make an adjustment. Like raised goodwill has been written off, but goodwill is not at all to be figured in the accounts, but the effect has to be there. This is what is called as adjustment of goodwill through partners capital account. However, if no goodwill account is to be raised, no goodwill account is to be raised, it is to be adjusted through however, if no goodwill account is to be raised, it is to be adjusted through partners capital accounts. However, if no goodwill account is to be raised, it is to be adjusted through partners capital account. Means gaining partner capital account is to be debited. This entry you will be writing where in the books of new firm. What is that entry you will be writing? Simple words, the entry is gaining partners capital account debtor entire essence of goodwill is the same. Gaining partners capital account debtor to sacrificing gaining partners capital account debtor to sacrificing partners capital account. Clear to all of you? Now, third point. Elimination of inter-firm indebtedness. Eliminating elimination of inter-firm indebtedness. Let me give a small example. Balance sheet of AB, balance sheet of CD firm. Sundry creditors 10,000 including due to CD, including due to CD, rupees 2,000. Now balance sheet of CD, debtors say 20,000 including due from AB, rupees 2,000. Right, understand. Sundry creditors including due to CD 2,000. This 10,000 rupees is including due to CD. Balance sheet of CD. Now what happened? Including due from AB. That means previously AB and CD were competitors. Two different firms. So maybe they have purchased some goods from CD, AB, and CD has sold. So since CD has sold, that means debtors is nothing but it is not only due from AB, due from some other customers also. But here, since AB and CD have merged together, now new firm is ABCD. Then what happened? Debtors 20,000, creditors 10,000. Then what happened here? Now this creditors and debtors belongs to, so creditors including 2,000 rupees to CD, debtors including 2,000 from AB. Now since both of them become, why should I give to you? Why should you give to us? Now we both have become a common friends now, so we can eliminate. That is what. So this is what is called as elimination. Okay, elimination means we have to reduce from new firm balance sheet of ABCD. What is common amount? 2,000, or sometimes minimum amount also we can say. Here what is the common amount in this? 2,000. This we have to eliminate. How to eliminate, sir? Because we need to reduce the creditors. The entry will be sundry creditors account debtor. Here just I have taken example. Creditors may include CD creditors also, but I have explained you to how to eliminate the mutual owings, etc. I've told you. Sundry creditors including CD, including due to CD 2000, debtors including due from AB. Why should AB should give to CD? Why should CD should receive? When both of them become common friends, you can avoid it, because it becomes asset and liability of the same firm. So this is what is called as elimination of inter firm indebtedness. So the entry will be, and even if you show the new firm has to receive, new firm has to give. Why should new firm receive? Why should new firm give? This is what is elimination. So sundry creditors account at R2. Because now it has become common assets and common liabilities. No, this is third point. And depending upon the problem, information given in the question, adjustment of capitals. Adjustment of capitals by taking one of the partner capital as a base. Adjustment of capitals as required by the problem. Like they'll be giving sometimes base capital or new capital. Like you have to find out the new capital on the base of one of the partner capital as a base, then the capital is according to their new profit sharing ratio. Adjustment of capital is required by the problem means capital accounts of the new firm will be capital accounts of the new firm will be in the new profit sharing ratio. And then last one, sometimes they'll be asking you to prepare balance sheet. Amalgamated balance sheet, new firm balance sheet. Amalgamated balance sheet of the new firm is to be prepared. Clear to all of you? This is how you should be doing it. Elimination of interfirm indebtedness. Example I've given you. Following example. Okay. I think go through this. We work out problem in the next class. So I think you got some clarity of thought on this. Okay, my dear friends. We'll meet in the next class. Till then, goodbye. Thank you. God bless you all.